Hello everyone, welcome to the Ashworth Wealth Weekly Market Update. We'll kind of jump into this week's slide, kind of talk about the U-shaped yield curve and how rare they are. We're currently in a U-shaped yield curve. Let's kind of talk about the different shapes that yield curves can be. The first of all, you can see it on the far left side there, the normal shaped curve happens over 70% of the time. What effectively means is when I say normal, it's upward sloping, meaning that the interest rate return you would expect on a 3-month bond is less than a 5-year bond, which is less than a 10-year bond. The longer you're willing to hold or you wait for that bond to mature, the higher interest rate you're going to get. A humped yield curve is when the 5-year rate is higher than both the 3-year and the 10-year. They don't happen very often, maybe 10% of the time. An inverted yield curve is when you get paid more money for your 3-month bond versus a 5-year and a 10-year. A U-shaped, which is what we're in right now, is where the 3-month and the 10-year are the highest yields, and the 5-year is kind of lagging there, I guess, for lack of a better word. And then a flat is when there's not a whole lot of difference between any of them. You don't get a lot of premium for waiting more and more time. So when we look at that, it's important to understand what's the environment we're in right now. What's that going to do to me over the long run? And so when we look at that, I think the important thing is to figure out, how does this affect my portfolio? For instance, you've probably seen right now that you can get really, really high interest rates on money market accounts, short-term CDs, 3-month, 6-month, that type of thing. Or you can get a high yield on having a bond being held for the long period of time. But anything in the middle is very, very difficult because there's just a lot of uncertainty in what's going on with inflation, what's going on with what the Fed is trying to do. So usually a U-shaped yield curve means that you're expecting the Fed to probably change interest rates. And you can kind of see that the Fed kind of signaled recently that they may be changing interest rates later in this year. So when we look at that, what does that mean for a portfolio? Most of the positions that we hold when it relates to bonds are short-term in nature, less than 3 or 4 years. We want to make sure that we keep those going in the right way because we don't want to take too much risk by going out too far. Because if we hold a bond that's got a long maturity over 5 or maybe 10 years, then you're locking into those rates, and we just don't know what the Fed's going to do. Usually a short-term bond rate of 3 years or less is better to do in the long run because you have less volatility as interest rates change. So having said that, we know the bonds in your portfolios have been doing very, very well the last 12 months. Probably in the 4 to 6% range. So that's really good right now. Having said that, we don't know what that's going to mean for the future. If the Fed does lower interest rates, which they usually end up doing when they have in a U-shaped yield curve, that we'll be able to get a little bit of a kicker on some of those bond funds and those bond ETFs or individual bonds that you own, because you're going to be able to have a bond sell for a premium. And so we'll kind of keep an eye on that as we do reviews and do some different things. And so for the most part, just understand that in this scenario right now with this U-shaped yield curve, we expect that the Fed rates are probably too high compared to those that are expected 2 to 3 years from now. So we'll kind of see what the Fed does. It means they're probably going to move. A lot of people are predicting they'll move 2 or 3 times before the end of the year. But the main thing is we want to be cautious with the extremes. We don't want to put too much money in short term. We also don't want to have too much money in long term. It's nice to have a little bit of money in 2 to 3 years, which is most of the bond funds that we look at are 2 to 3 years because they're the most, I wouldn't say safest, but they're probably the least volatile as interest rates are changing in the long run by as you go up and down what the Fed is doing. So we'll keep an eye on that, but want to give you a heads up of what's going on with that. Some of this is kind of difficult to comprehend and understand, but just for the most part, understand this. The U-shape just means that the 5-year bond interest rate is paying less than both the 3-month bond and the 10-year bond. And so we want to be very careful about holding anything over 3 or 4 years because you're not getting rewarded for the risk that you're taking. So hope that makes sense. Keep us posted if you have any questions. We're always happy to meet and talk about any concerns you have. We are in the middle of doing some of our fall reviews, and so we'll kind of go through that process. Those of you who are coming in for the fall doing some year-end tax planning, if you have any questions in the meantime, please reach out to us anytime, and we'll look forward to seeing you soon. Thanks. Bye-bye.